A rise in short-term yields will be bad news for bad vodka.
Rising rates means that bad vodka is going to have a hard time.
Yeah, specifically rising short-term rates is probably going to be bad news for I don't want to say cheap, a bargain vodka like this.
All right.
Let's get into it. Welcome to the knock-on effect, where we start with the thing you know and end up in a strange place. And joining me today is the toast of the town, my fabulous co-host, Justine Underhill.
Thank you.
And here in spirit, the man who's smarter slosh than I am sober, the professor himself, Roger Hurst.
Slanjava.
I don't know what that is.
It's an English bastardization of Gaelic for good health.
Learned something new.
Well, Slanjavar to you too. So after today's main segment, Justine will talk about something interesting that's happening in the world of high-frequency trading in our new segment, What the Frequency? Excited for that. But first, Justine, Roger and I are going to try to get you from rising rates on the short-term world to stuff like this, being in trouble.
Okay.
And what do you think? What's your guess?
My guess. Okay. Yeah. So I think rising rates will have an impact on emerging markets.
You always start with this?
I love emerging markets.
Am I wrong? She always starts with this, right?
But think about this. So it will have an impact on Russia, and that's where you have a lot of cheap vodka. I'm guessing. I don't know. Are these from Russia?
The problem is this is bottled in the U.S. I don't know where it was made. This is made in the U.S., by the way. This Barton stuff.
So
Bartons.
Yum. So then maybe people in Russia won't drink as much cheap vodka.
It's all right. We'll get there. We'll get you there.
No great.
Okay, no great. So let's start with what we do know, which is that short-term yields have risen really substantially. The U.S. 2-year Treasury yield, which shows how much money you'll get back if you lend your money to the government for 2 years, has risen from, over the past 2 years from 0.7% to 2.6%. So, Roger, what's going on here?
We've got tight labor in the US. Doesn't necessarily mean strong labor force, but a tight labor market. We've got loose financial conditions. So even though the Fed's been raising rates, financial conditions remain near rock bottom. And we've got rising inflation expectations, albeit modest, and a Fed that wants to be rearmed for the next recession and wants to move away from the zero bound. So they've been raising rates.
Right, and as the Fed raises rates, just if you could just solve the puzzle for us, Roger, that as the Fed raises rates, rates that are closer to the rate the Fed targets also rise too, right?
Absolutely. So the more sensitive you should be at the front end rather than the back end. So Fed raises rates, which is spot rates, and 1 month will be more sensitive than 3, than 2 years, than 5 years, or so the theory goes.
Right, there you go. And so short-term rates have been rising, but those long-term yields, the amount you get for lending your money to the government for a longer time, have barely budged. It's actually really weird. So at the beginning of 2014, the 10-year yield was almost 3% higher than the 2-year yield. And now it's like 0.25% higher.
Right. So basically, we've seen a flattening of the yield curve. So if you look at short-term rates versus long-term rates, the Fed's raising short-term rates, and then long-term rates haven't really moved. So you've seen this flattening.
Exactly. And so, if you zoom out, just like I like to think of things on a really basic level, like why should long-term rates be higher than short-term rates? I mean, after all, if you buy a 2-year bond, you get the money back. You buy another 2-year bond, you get the money back. Basically, should be the same as buying one 10-year bond. However, you are locking your money up for a longer period of time. There is, not really in the U.S., but there could be credit risk. I mean, some weird disaster could happen. The U.S. wouldn't pay back their debt. Or there could be a lot of inflation, and then the rates would rise, and you wouldn't get to capitalize on those rising rates if you owned a long-term bond.
Right. Anytime you have or you lend your money out for a longer period of time, I would expect a higher return. I mean, there is higher risk, and so that is kind of strange that long-term yields are getting closer and closer to short-term yields.
Yeah, because 2.6% is also a very widespread over the past 40 years. The average has been about 1%. That the 10-year yield is higher than the 2-year yield. But yes, as you pointed out, we've recently seen flattening, which has become a really hot topic.
Yeah.
It seems like you can't, feels like I was watching golf and they were talking about yield curve flattening. It's like a hot topic now.
Everyone's talking about it because it's the favorite recession indicator. Anytime you have a yield curve inversion, which is where long-term rates dip below short-term rates, then that's the signal for a recession. So that's like everyone's watching out for that.
You're like the adjunct professor today.
Yeah.
Professor, why do people look at this so closely? Why is it the indicator of recession?
Well, what we've seen is since pretty much the early 1980s, every single recession has been preceded by an inversion. But you've got to take into account that inversion has usually happened between 6 and 18 months before the recession. And in fact, the curve is normally re-steepening. But the point here is that you get the Fed gets on the march, starts to be kind of aggressive on the rates, and people start to worry that they go too aggressive and slow down the economy. So the assumption is the Fed raises rates, they slow down the economy, long-term yields start to falter because they start to price in that slower long-term growth, and hence you get the flattening and potentially the inversion.
Yeah, and actually, I just like to explain there. So a lot of the reason that you have that inversion where short-term rates are above long-term rates is that people or investors are much more worried about the short term, so they need a higher return in the short term than for the long term.
Right, because in the long term, they don't think the economy is really going anywhere fast. So usually when the economy expands, you get inflation, et cetera, but they don't think that's going to happen. And that confluence of people being really anxious about the short term and people not being optimistic about the long term is the inversion, which is the indicator of recession. Now, recession is our next knock-on effect. Again, not something we're predicting, but if you follow the trail of breadcrumbs from higher yields to Grandma's house. Grandma's house?
Where's Grandma's house?
I don't know. Hansel and
Is
Gretel.
that Grandma's house the Fed? It's
No,
always the Fed.
It's Grandma's. No, the Fed is the witch that
Oh,
cooks
okay.
the children. I don't know. Let's forget that metaphor and just talk about what will happen if there is a recession that would have been predicted by a yield curve inversion.
Okay.
So easy to think of it as an economic thing, as a thing that happens in markets. Investors are obsessed with recession, which is understandable because years of gains can be gone in weeks. I don't know. Maybe if I snapped for weeks at a time. But,
Really slow snap.
Yeah, exactly. But why does slow snapping never? Slow clap became big, but no one ever does this
Slow snap.
Isn't that weird? But
You could start it.
I could. But as we talk about recession, in the markets, it's important to consider what that actually means in the economy and what it means for people, because that's what an economy is. And before we move on, I'm going to warn you that we're about to take a pretty dark turn.
Okay.
And before we take that turn, Justine, you want to take another crack at guessing this?
A dark turn. So maybe if there's recession, as the economy does worse, maybe people drink more and they get more drunk, but then they want higher quality vodka. I don't know.
Yes, so you're asking the right questions.
Yeah, I was trying to go in a dark place.
Yes, so that's exactly where we're going. It's going to be actually darker than that because last week, the medical journal BMJ published a study called Mortality Due to Cirrhosis and Liver Cancer in the United States, 1999 to 2016. And what the study showed is that in the US, deaths from cirrhosis have actually been rising pretty dramatically, have increased by 65% since 1999. And the largest increase has come in the 25 to 34 age group.
Okay.
And the authors, Drs. Elliot Tapper and Nihar Parikh, write, quote, there was an inflection point at 2009 where cirrhosis-related mortality increased statistically significantly. Here's what they draw from that, continuing to quote, given that the worsening trends began after 2008, a year marked by the global financial crisis and a subsequent economic recession in the USA, no one ever says USA anymore. A differential economic impact on specific states may explain some of the results. Since increases in mortality were greatest for young men, these data may dovetail with trends in alcohol misuse established to predominantly affect younger men. Becoming unemployed is linked with alcohol misuse in young men, but not older people or women.
Okay, so this is really going to affect the younger male demographic.
So when we do have a recession, people might turn to abusing alcohol, particularly young men. And I do want to add a little caveat because there's sort of an interesting wrinkle I want to add here. It comes from a paper published earlier this year in Social Science and Medicine, and it's called The Impact of the Great Recession on Health-Related Risk Factors, Behavior, and Outcomes in England. Hi, Roger. The paper reads, our findings indicate that the recession is associated with a decrease in the number of cigarettes smoked and a decrease in fruit intake. That's kind of irrelevant. They also found a reduction in alcohol intake. Meanwhile, obesity, diabetes, mental health problems increase. So the average person drinks less.
Oh.
Average person drinks less. It's sort of, maybe you're at a restaurant. Do I want some wine with my meal? Maybe I can't afford it. So the average person does drink less, but it seems that some people abuse
And drink more.
and probably of like shoddy stuff like, I don't want to say, I don't have the full tasting notes on these, so I can't really give a full breakdown, but these, I doubt they're great.
Yeah, this looks like cheap stuff from the liquor store. I hope you didn't spend too much on it.
So this one, by the way, was $17.
That's a lot of liquor.
I know. This could kill everyone on set, I think.
Yes.
Right? This is, so it was about 50 cents per alcohol shot. Isn't that incredible?
Oof.
Yeah, I just walked in like on Monday morning at 9 a.m. and said, "What's the cheapest alcohol you have?" So who knows what he thinks of me. But we're not done yet, because if alcohol abuse does get really bad, then policymakers could respond. And now I want to go back to, well, not England, but Great Britain. And Roger, tell us what happened in your northern neighbor.
So we're talking about Scotland here, and on May the 1st of this year, 2018, a minimum pricing of alcohol came into effect. So in Scotland, not every, but the average Scottish person consumed 10.5 litres of pure alcohol. It's equivalent to 20.2 units per adult per week versus a recommended dose of 14 units. So the average Scot, and remember a lot of Scottish people do not drink at all, but the average Scot was exceeding the guideline by 44%. And indeed, there was one 2-litre bottle of strong cider where you could get your full weekly dose, your 14 units, for as little as £2.50, which is about $3.25.
That's Frosty Jack's, I believe, is the...
I've never tried the stuff myself, but you're probably right.
No, you never had it?
I just can't believe there was a recommended dosage of 14
Well,
units.
no, it's that every person, if every person was drinking, then everyone was going over. So obviously some people are probably overdoing it.
Pulling way over.
Yeah, so, and what has the effect been of this Scottish ban, or Scottish minimum pricing?
It's actually had an impact. So, and indeed, it's actually been cider where the biggest hit has been found. So the sales of cider, all ciders, has fallen by about 8%. I think prices on average have gone up about 25%. But that cheaper model that I was talking about earlier, that would have nearly tripled in price because each unit of alcohol is being minimum priced at around about 50p. So 14 units works out at £7. So it's had a big impact on some of these lower quality brands in terms of sales.
It's funny. I would have thought, because recession, people are possibly drinking more, or certain segments are drinking more. So therefore, these alcohol companies would do really well. But then you get regulation coming on board, and whoops. Maybe not so much.
Just to tie the loop here, so Scott, I want to actually give a response to that specifically. But so Scotland's considered the first country to have instituted minimum alcohol pricing. In Canada, several provinces have minimum alcohol prices. In Europe, Russia, Ukraine, Belarus, Kyrgyzstan, Moldova, all have some form of minimum pricing. Maybe it's just on vodka or something like that. In Australia, this is very recent, the Northern Territory implemented a floor for alcoholic drinks. And just because we've been talking about scientific studies, there are studies showing that these minimum prices do lead to fewer alcohol-related issues. Not a huge surprise since humans respond to incentives. And so getting back to this paper that came out last week about cirrhosis and liver cancer, the authors write, in addition to resources for alcohol-related disease, the role of state-level policy instruments such as increased taxes on alcohol deserve attention. In this regard, forthcoming data from Scotland will prove instructive. Having mandated for alcoholic beverages a minimum of 50 pence per unit price, the impact of this program on Scottish public health should be eagerly awaited by American policymakers. So that's the next knock-on effect. If the next recession leads to a sharp increase in dangerous alcohol abuse, America might end up mandating a minimum price for alcohol, and that means that horrible vodka like this could be in trouble. So, this I bought for, like I said, it is about 51 cents a shot. That could be below the minimum price. Now, what's interesting is that there's been so much consolidation in the liquor space that the same company that was bought by, I believe, Constellation, the parent company was bought by Constellation, sold to Sazerac brands, which makes actually a lot of really great whiskey. So they also make this, which is not great. Georgie is a different company. Ross's Retreat, by the way, this is kind of funny. This was $4, and it is made by the same company, Penfolds, that made that great Australian wine we talked about a few weeks ago for $4 from Chile.
It's almost freaking me out that this stuff is so cheap.
I know.
Like, it's almost like
It's almost like that shouldn't be, right?
yeah. It's like, what is it made from, or how did they make it?
Well, it's cheap to make alcohol if you're not doing it well. But who knows how this will play out? In Scotland, actually, they couldn't. I don't think they could institute higher taxes on alcohol because of the way they're structured as part of Great Britain. Whereas in the U.S., it would be easier to. And we do have taxes on excise taxes on liquor, high tax on liquor. But who knows if minimum pricing really works out in Scotland, that could be the way policymakers
we have
go.
cigarette pricing. We have all sorts of, but it's state by state dependent. But that's a big factor. I know in New York, there's huge taxes on cigarettes, and so that's impacted the cigarette market. And so I wouldn't be surprised if there's something that happened with alcohol. Although Americans love their alcohol, I would say riots in the streets.
And Prohibition did end during the Great Depression, right? So
yes.
there is actually a link with easier laws on alcohol in times of economic stress. But Roger, what do you think? Do you think that that in the next recession we could see? I wish you were here to share this with us. But do you think we could see this kind of stuff be cut back on, or policymakers cracking down in some form?
Well, I guess the problem is that those who are going to abuse substances will always abuse substances. And if you push up the price of alcohol, then doesn't it make some of the illegal substances, whose clearly the price won't change because they're unregulated, makes them more attractive? So I think if you are going to abuse substances, you will do. I think what it prevents is, the sort of the younger groups who might just have these sort of binge drinking sessions on a Friday night. But the data, it's still too early to tell because obviously it's only 2.5 months old. But I think the risks are, if you're going to drink, if you're going to abuse yourself, you're still going to do it. And that's not going to change.
Or you move to another drug. So really, I do see a lot of these taxes or whatever minimum prices that they put on. It just means that there becomes a black market. It just means that people start brewing gin in their bathtubs.
I don't know. It's hard to get cheper than this is the thing.
Yeah, that's true.
We're pretty much at the floor.
I will say it's also interesting to note that all the countries you mentioned, with the exception of Australia, are northern countries that have less exposure to sunlight. No, but that makes a big difference. And so in terms of depressive attitudes and other issues there, mental health issues, it's a little bit more prominent.
Yeah, well, Russia, interestingly, they had a minimum price on vodka, and they actually cut the minimum price during the time of economic stress recently when oil prices collapsed.
To help ease the pain.
It cuts both ways, yeah, to ease the pain there. But I think, in general, I think it's just important to remember, getting back to the really dark middle we had here, this knock-on effect, it's important to remember that these, a recession is people losing their jobs, not able to find a new job. It's people who are struggling to get by, really, not surviving, right? So it's important to remember as we look at markets, like, this is not trite stuff. And
I will say, not just with the yield curve flattening, but just the fact that we're raising rates often goes hand in hand with change in the business cycle and possibly a recession. So, it's just how the economy has worked. Maybe we'll raise rates and won't have a recession, but even if the yield curve doesn't invert this time around, there's still a possibility that will have a recession anyway.
Fair enough. So we are not done yet because we're off to our new segment, What the Frequency, which Justine is going to present to us now.
Yes, welcome to What the Frequency. So there's something that's a little bit strange going on right now with the U.S. Department of Agriculture. So there have been concerns about high-frequency trading for over a decade now. Whether it's good or bad, that we'll save for a completely different debate on another day. But right now, high-frequency trading is top of mind for the USDA. And starting next week on August 1st, they are going to change how they release their crop information and data to the public. Okay, so here's how it currently works. Right now, a bunch of journalists go into a lockup room at 10:30 in the morning. They don't have cell phones. They don't have any access to internet or anything like that. They go to a computer and they get access to the report. Okay. And then they get to write their news article. Okay. And then exactly 12 o'clock on the dot, they release it to the public, and you and me get to read it on whatever website we want. However, the USDA, when they release their report on their own website, it takes them 2 seconds to actually get it up and fully load it onto their website. Okay. So technically, a lot of the media outlets are releasing their information 2 seconds before the USDA does. And that means that a lot of high-frequency traders are going to Bloomberg and Thomson Reuters and Dow Jones and paying them lots of money to get access to this data. So in that case, it doesn't seem fair. Like, why is it that these high-frequency traders can pay these media companies to get faster access 2 seconds before everyone else? So what the U.S. Department of Agriculture is doing is they're changing this. They're going to say no more media access to these reports, no media access earlier than anyone else. And I have this quote here from Agriculture Secretary Sonny Perdue, who said, quote, the new procedures...
Sonny Perdue, is such a good name for an agriculture secretary.
Yeah, isn't that wonderful?
Sonny Perdue, are you kidding me? All right, sorry, go on.
So Sonny Perdue said, quote, the new procedures will level the playing field and make the issuance of the reports fair to everyone involved. And this is where I take issue. This is where I say, what the frequency? Because this doesn't...
As you so often say.
As I always say, this doesn't really level the playing field. And what drove me even more crazy is that we have these headlines coming out saying, from the Wall Street Journal, U.S. tries to rein in high-speed trading in farm patch. This is not reining in high-speed trading by not allowing the media to access these reports earlier, because all that's going to happen, the USDA is going to release the report on their website, and whoever's fastest, whatever bot is the fastest to get to the USDA website, will get there first, and that's how it's going to work. And so it doesn't really make sense to me that they think of this as leveling the playing field when it's still completely uneven, if that's what they have in mind. The other part of this is that why couldn't they just release the report or have the media release their reports 5 seconds after or 2 seconds later to have it released at the same time? So right now what's going to happen is that all the media reports are going to come out 10 to 15 minutes later, and that's going to limit the wide distribution of the information.
And it will also increase the chance for errors in the media reports, because it's like when there's a Supreme Court case, the reason that though often those are misreported is because there's no embargo.
Right.
So just an intern races across to hand it to a reporter. It was overturned. Oh, no, it wasn't overturned. Never mind. Right. And so media will still race with each other to try to get their fastest, but they could make a mistake.
And then they will be prone with
That's
mistakes.
why there are embargoes, by the way.
Oh, absolutely. And so I mean, as a journalist who used to go into the Fed lockup room where there was very strict protocol and, being able to read through the report and have that time to digest it and then be able to write your article makes a huge difference. And it just makes it a lot more secure and faster, I believe.
The other thing, listen here, Sonny. The other thing that I really disagree with is that, these high-frequency traders, they're trying to integrate the information into the market as quickly as possible. And it's basically, some people maybe with machines competing with some people who are trying to do it by hand. And, they're information traders. They're trying to get information into the markets. Like if I'm sitting there at home, first of all, no one at home trades corn or wheat, period. But if I'm sitting there at home, trading corn, I'm never going to be faster than the guys who have it piped in, even if they're getting it piped in from an API or something scraping the USDA website rather than pipe it in directly from Bloomberg or Reuters. So I don't even know who we're trying to protect here. Like they're just trying to get the information in the markets as quickly as possible and make a buck doing it.
Yeah.
But there's nothing untoward happening.
Right. So all that really happens in this case is that high-frequency traders have to pay a little bit less because they don't have to pay for access to Bloomberg or Dow Jones or Thomson Reuters. So that's really the biggest change here. And so they make out a little bit better, I would assume. So yeah, USDA, what's going on?
I knew you wanted to say with the frequency right there. I don't know what happened.
Well, I controlled myself.
Because usually you say like 10, 20, 30 times a day, so I thought,
Oh yeah, that was my favorite line. I say it in the mirror.
Roger, are you with us or are you with Sonny Perdue?
I think that the high-frequency trading or just the information should be available to all at the same time, and no one should have an advantage. Otherwise, it's effectively inside trading. So information should be equal and on an equal platform.
But then there are other ways to go about doing it. And so that gets to my point, is that then the media reports could be released 2 seconds later, so it's on par with, or 5 seconds later, why not, so that they don't have an advantage. I don't see any reason as to why the media reports, they can't have the lockup room. To get rid of it completely doesn't make sense to me.
But it's interesting because Roger's with Sonny Perdue, right? You're kind of more concerned about this than we are.
Yeah, I think so. I think that in a world of kind of free markets and efficient markets, no one who's got a bigger pocket should be allowed to get an advantage in trading. So whether the man at home or the woman at home is going to trade on this information is not the point here. there should be a quality of information and a quality of opportunity of that information. And clearly there isn't here.
But there's never going to be inequality because, one person has a giant trading computer that's taking in information from everywhere else, and they know how this report is affected, and they're running all these, complicated algorithms. And I'm at home saying, "Oh, there's not so much corn. I'm going to buy corn." It's like we're never going to be equal.
But let's say you had a good interpretation of that data, and you got it at exactly the same time as someone else, and you could press your button at the same time as somebody else. It might be that in that time that 2 seconds, the market's moved 2%. It could have hit a stop. At which point you just lost out on 3% versus the person who got it 2 seconds ahead of you. How is that fair?
Well, I think we're also dealing with millionths of a second here. So, I mean, really what it comes down to is, these bots racing against each other. And then you could have the other argument that is it even worthwhile to develop this technology where we have these bots racing against each other? I mean, it's to what end does this go?
Money.
Money. To that end, yes. We followed the breadcrumbs.
Yeah. By the way, they're making vodka with corn now, so that's the tie-in. That's that Tito stuff. That's why it's so sweet, because they make it with corn. Before we go, I think I see my boss over here. So, ladies and gentlemen, Raoul Pal, the co-founder.
Hey guys, how are you?
Hey there.
This is what you do when I'm not around, right?
Or
I've driven you to alcohol.
Yeah, we're just about to. We finished the small one. We're about to get into the big one, and this is a good deal, by the way.
Perfect
$17.
timing. It's not even 11 o'clock.
Yeah, I know, but you got to start early if you want to be really drunk by 2 o'clock. That's what I always say.
Okay, good.
So this is $17, but you're actually here. It's kind of an awkward transition, but you're here to tell us about maybe a better deal even than this, which is something going on with.
That sounds a very cheesy intro, but yeah, it's Macro Insiders. It's the research service that I write with Julian Brigden. And we've got a special offer running now, so that's why I came to muscle myself in here to say hello to everybody and see if we can get people to have a look at what we're doing with Macro Insiders, because it really is a unique research product, because both Julian and I write these kind of big picture macro research services. Mine's Global Macro Investor, his is MI2 Partners, and they're both aimed at the institutional market. It's mainly for the world's biggest hedge funds, pension funds, family offices, that kind of thing. And some subscribers from Real Vision said that, why don't Julian and I get together? They'd seen us on videos before and said, you guys kind of think in a similar manner, but you offer different perspectives. Why don't you get together and do something aimed at the more average investor? So that's what Macro Insiders was. It's been running for about a year now. It's been really, really well received. It's a really different service because we kind of do a mixture of video. So I think people saw us doing the video recently.
Yeah.
So we do that every month, but we also both write a piece each. And then we also give a piece of our own very kind of expensive high-end research services. We show a full piece from that as well. So they get to see what the cool kids are looking at, what the real research is that everybody's got. So yeah, I mean, that's Macro Insiders.
And if you guys want access to that special deal, make sure to go to realvision.com/macroinsiders2018 where you can sign up for it. All right, that does it for this week's Knock-On Effect. Raoul, Alex, thank you guys so much. And I think it's time to
Time for the vodka.
Yeah, I
crack
think
open
so.
the vodka.